So summer winding down, earnings season is basically done. We're on the verge of election season. And of course, we got to this new high. And I think the way we got to the new highs is relevant. It was a very hard-won breakout. You were below the old January highs for 7 months. When that happens, generically speaking, when it's happened in the past, that's been a good thing if you've had this long repair process after a correction. That's a 2-year chart of the S&P 500. You see, you've almost just resumed the uptrend in the same angle that you had from mid-2016 with just that big eruption to the upside, then the sharp gut check, and then you've kind of continued on that up. So all that stuff looks good, and the forward indications when you do have this kind of a breakout after a long sideways period are positive, in fact, more positive than they are on average. Also, when you're up about this month, year to date, that also tends to be good, between 5 and 10% in August. I do think the question, though, is how much of the good stuff we've already figured out, will the market remain difficult to please? And I think the way I say it's difficult to please is that earnings are up 20 to 25%, S&P's up 8%. So clearly the market is bracing for the possibility, the likelihood that it trails off from here. And just the sheer brute force of all the good news with all the dividends and buybacks and the repatriation and treasury yields staying lower than you expected and credit markets remaining flush, all that stuff has got you to an 8% year-to-date return, which is nothing to sneeze at, but it just maybe indicates it's going to become all about 2019, all about what growth looks like then, and of course the Fed and all the rest of it.
That's really a key point you make in terms of what's next and sort of when you start to turn to September and onward. I mean, in terms of major catalysts for the markets, it looks like there's midterms. I mean, you got a little more time until we get to the next earnings season.
I think the midterms, most of what has to happen there is for the election to be over. Now, that's usually the pattern, is the market kind of gets some anxiety ahead of a known event like an election. Obviously, the result matters, but I think it's much more about getting past it. I will look back to last year, though. Last year was fascinating because August was when the market lifted off and accelerated to the upside. And you really couldn't point to anything in particular except it was pricing in those tax cuts that were likely to come. And they seemed likelier as you went along. And everyone keeps pointing out, well, the market's cheaper than it was in January, right? On a PE basis, it was at 18.5 times then, and it's like 16.5 times now, right? Why was it at 18.5 times then? Because the market knew you were going to have this once-in-a-lifetime huge step function increase in earnings late in an economic expansion, which you almost never see. So that's why I think it's give and take going into 2019 in terms of just the durability of the cycle. It's going to be the overhang. I don't think it's about to end. I still think the upside is kind of has where the weight of the evidence lies, but it just might not be a rapid gain. I think you could have January, you could look back at January and say that was the momentum peak, that was the optimism peak, that was kind of the, I guess, the best moment, how it looked easy for the bulls, but not the ultimate peak in prices or value.
Right. And recall, it was undone by a spook on wage growth in February, right? Which ostensibly you could see again. We'll see if the result is the same or anywhere close.
Right, exactly. And that's why at this point in the cycle, people always say, well, cycles don't end of old age. And well, what happens is the economy has a hard time putting to work scarcer resources at a profitable rate of return. I mean, that's really what goes on, and that includes labor.